Over the last 2 decades, more than 90% of professional, actively managed investment funds have failed to beat a simple market index. These are the experts, with entire teams dedicated to picking stocks. Yet, they consistently underperform a basic automated strategy. This begs the question, if the experts can't win the game, how can you? The answer is to stop playing their game altogether. The modern investor faces a paradox of choice. You are bombarded with information, with so-called gurus promising to have the next big thing. This complexity is designed to make you feel like you need them. It creates analysis paralysis, leading to 2 common outcomes. You either do nothing, letting inflation erode your savings, or you make speculative bets based on hype and emotion, treating your financial future like a lottery ticket. This is not a system. It's gambling. At the Wealth Algo, we replace complexity and speculation with logic and systems. The solution is an elegant and robust system known as the 3-fund portfolio. It's a strategy championed by legendary investors like John Bogle, the founder of Vanguard. It requires no market timing, no stock picking, and no financial genius. It consists of just 3 components. Component 1, the growth engine. The first fund is a total U.S. stock market index fund. This single fund buys you a small piece of thousands of companies, from tech giants to small innovators, across the entire U.S. economy. Why does this work? Because you are not betting on a single company to succeed. You are betting on the long-term growth and innovation of the American economy as a whole. Historically, this broad bet has been one of the most reliable wealth generators in the world. By owning the entire market, you capture all of the upside while being protected from the failure of any single company. It's maximum diversification with minimum cost. Component 2, global diversification. The second fund is a total international stock market index fund. This gives you ownership in thousands of companies outside the United States. The logic here is simple. The U.S. will not always be the world's top-performing market. Overlooking global markets is a critical error known as home country bias. Data shows that market leadership rotates. By owning both U.S. and international funds, you ensure that no matter which region is leading the charge, your portfolio benefits. This is a fundamental rule of risk management. Component 3, the stabilizer. The final component is a total U.S. bond market index fund. Think of this as the portfolio's shock absorber. This fund holds thousands of high-quality loans to the U.S. government and stable corporations. While stocks are the engine for growth, bonds provide stability. During stock market panics and recessions, investors flee to the safety of high-quality bonds. When stocks fall, bonds tend to hold their value or even rise. This inverse relationship cushions your portfolio from severe losses, reduces volatility, and allows you to stay invested without panic. So, how much do you allocate to each? The algorithm is simple and adjusts with your age. A common rule is 110 minus your age in stocks. For example, a 30-year-old would have 80% of their portfolio in stocks and 20% in the stabilizer, bonds. That 80% stock allocation would then be split between U.S. and international. A standard split is about 80% U.S. and 20% international. As you age, your allocation to bonds systematically increases, reducing your risk as you approach retirement. This is your portfolio on autopilot. Once a year, you rebalance to maintain these target percentages. That's it. Let's summarize the 3-fund algo. 1, a total U.S. stock market fund to capture the growth of the American economy. 2, a total international stock market fund to protect against home country bias and capture global innovation. And 3, a total bond market fund to act as a stabilizer during downturns. This system removes emotion, ego, and complexity. It's a disciplined, data-driven approach that has proven effective for millions of investors. It allows you to build wealth systematically, while you focus on living your life. Stop looking for the needle. Just buy the haystack. Subscribe for more data-driven wealth strategies.